If a caller tells you they can help you activate, unlock, or protect your senior homeowner savings, and it sounds official, sarcastic, that does not make it safe. In a lot of cases, it makes it dangerous. One of the most expensive myths in America right now is the belief that if a tax break or relief program is real, then the phone call about it must be real too. False. And for homeowners over 60, that false belief can cost you not just a small fee, but years of missed savings, exposed personal information, and in some cases, a tax bill that stays thousands of dollars higher than it needed to be. The scam is not always obvious. Sometimes the damage comes from the caller taking your money. Sometimes it comes from the caller stopping you from filing correctly. Sometimes it comes from you hanging up, feeling reassured, and assuming the system will handle the rest because they already called me. That is exactly how people lose out. And if you stay with me, I am going to show you why the real danger is not just the stranger on the line. The real danger is the myth underneath the call. Because the myth goes deeper than this first lie. Underneath it is a second lie almost nobody catches. Then, underneath that, is a third lie that keeps perfectly eligible seniors from ever filing at all. By the end of this video, you are going to know which calls to ignore, which savings are real, which offices actually handle these claims, and what form names and deadlines matter in 2026 if you want the money to show up on your bill instead of staying in the system. Read that again. Eligibility is not the same thing as receiving. You still have to claim what is yours. So, where did this myth come from? It came from a very profitable mix of government complexity, county-by-county variation, legal language nobody translates, and a marketplace full of people who know confusion makes money. If you are a homeowner in retirement, you are now dealing with assessors, treasurers, tax departments, school tax programs, county deadlines, renewal rules, and sometimes separate state relief programs layered on top of local exemptions. That complexity does not just confuse people, it creates an opening. Scammers benefit because confusion makes you pick up the phone and trust the loudest voice. But silence benefits the system too. Not because there is a secret room where officials sit around plotting against you, but because no large system is built around making sure every individual homeowner understands every available savings path. Many offices publish the form. Fewer explain it in plain English. Many programs exist. Fewer are proactively claimed. And when people do nothing, budgets stay simpler, backlogs stay smaller, and the unclaimed money stays unclaimed. That is why so many decent, careful homeowners say the same sentence to me. If this was real, somebody would have told me. I understand why you think that. You paid taxes for decades, you kept records, you followed the rules. You assume the reward for doing all of that is that the right office will alert you when you qualify. But in many places, that is not how this works. In many places, the burden is still on you to file, renew, upgrade, appeal, or correct the record. And that is why a single phone call can be so costly, because it lands on top of a false belief that was already there. The caller does not need to invent the whole story from scratch. They only need to lean on what you already suspect, that someone official is finally reaching out, that somebody is finally helping, that maybe all you need to do is confirm a few details, pay a processing fee, or wait for the savings to appear automatically. That is layer 0. Now let's tear down the rest of it. If we have not met, I am Emma Smith. I am a licensed estate attorney, and for more than 15 years, I have worked around the legal and financial problems that hit older homeowners when paperwork is missed, deadlines are blown, titles are messy, or benefits are assumed instead of claimed. I need to say something clearly at the start. I do not make a dime if you file a Homestead exemption, a senior freeze, a star upgrade, or a deferral correctly. I am not selling your information, and I am not being paid by any county office to say this. I am also not your personal lawyer through a YouTube video, so for anything sensitive, verify with your county assessor, treasurer, state tax department, or your own licensed professional before acting. But I can absolutely help you see the trap more clearly. And what I want for you in this video is simple. I want you to stop confusing legitimacy of a program with legitimacy of a caller. Those are not the same thing, not even close. Myth layer 1 is this: if the tax break is real, the person calling about it must be real. The Federal Trade Commission says if someone claims to be from the government and demands money or personal information, you should hang up and contact the agency directly using a number you know is correct. USA.gov says government agencies usually initiate contact by letter unless you contacted them first. That matters, because scammers know you have heard of real things like exemptions, freezes, credits, and senior tax relief. They borrow the truth of the program to sell the lie of the call. A caller does not need to sound cartoonishly evil. They can sound patient, local, informed, even comforting. They may mention your county. They may say, "I'm calling about your senior homeowner exemption." They may say, "I see you have not activated your over 65 tax protection." They may say, "I need to verify your parcel number so you do not lose your benefit." That is how people get pulled in. Not by obvious nonsense, but by a sentence that sounds about 80% plausible. Here are the red flags in real life: pressure, urgency, threats, strange payment methods, requests for bank information, social security numbers, debit card details, or instructions to buy gift cards, move money, wire funds, or secure your account. The FTC is very plain about this. Real government agencies will not threaten you, demand immediate payment through gift cards or cryptocurrency, or tell you to move cash for protection. If that voice on the phone is trying to speed you up, scare you, or isolate you, that is not help. That is a setup. And retirees are targeted because you are more likely to own property, more likely to be managing fixed income stress, and more likely to have heard just enough about exemptions to know the words without knowing the filing mechanics. New York's own tax department has warned about phone scammers manipulating caller ID to display legitimate department numbers. Read that again. A real number on your screen is not proof. A familiar agency name is not proof. A real program name is not proof. The only proof is when you hang up and independently verify through the official office. But layer 1 is only the surface problem. If all we had to deal with were obvious scammers, this would be easier. The deeper issue is that many people assume the call means the process itself is already in motion. That is layer 2. And layer 2 is worse because you can lose money even without sending a scammer a single dollar. You can lose it simply by believing the wrong thing about how claims actually work. Myth layer 2 is the one I wish every homeowner understood years earlier. If you qualify, the system will automatically give you the savings. False. In many jurisdictions, you have to file, sometimes once, sometimes annually. Sometimes you have to upgrade from one program to another. Sometimes you have to prove income every year. Sometimes you have to fix the title first. The money does not arrive because you deserve it. It arrives because the claim is made correctly. Take Texas. The state comptroller says residents' homestead exemptions are generally filed with the appraisal district in the county where the property is located, and the general deadline is before May 1st. The official form is Form 50-114, Application for Residents' Homestead Exemption. In 2026, school districts are required to provide a $140,000 residents' homestead exemption, and for homeowners age 65 or older or disabled, school districts must provide an additional $60,000 residents' homestead exemption. Those are not small numbers, but they do not help you if you never file with the appraisal district. Look at California. The homeowner's exemption is real. The state says it reduces taxable value by $7,000 for a qualifying owner-occupied home. But to claim it, the homeowner must make a one-time filing with the county assessor using Form BOE-266, Claim for Homeowner's Property Tax Exemption. If you file by February 15th, you can receive the full exemption for that year. Again, real benefit, real form, real office, not automatic just because you own the house and live there. Now look at Cook County, Illinois. The assessor's office lists a senior exemption that generally auto-renews once applied, but the low-income senior assessment freeze exemption does not auto-renew and must be filed annually. applications submitted after May 15, 2026 are processed as a certificate of error. That is exactly the kind of detail people miss. They remember hearing senior exemption once and assume all senior tax relief works the same way. It does not. One program may continue. Another may require yearly proof. Confuse the two, and you can lose savings you were counting on. Oregon's Senior and Disabled Property Tax Deferral Program is also real, but it is not magic. The state says eligible homeowners can borrow from the state to pay property taxes to the county, and you must file with the county assessor by April 15th or file late with a fee. Colorado says qualifying senior homeowners can exempt 50% of the first $200,000 of actual value of a primary residence, but the ownership and occupancy rules are strict, and the application still has to be made. Different state, different mechanism, same truth. If you do not claim it the right way, the money does not move. This is the sentence that should be taped to your refrigerator if you own a home in retirement. Eligibility does not equal receipt. Eligibility does not equal receipt. Eligibility does not equal receipt. That is layer 2. And once you see it, the next lie becomes easier to spot, because a lot of people are not just waiting for the system to act. They are silently disqualifying themselves before they ever check the real rules. That is layer 3. Myth layer 3 is softer, quieter, and in some ways more expensive than the scam call itself. It sounds like this: I probably make too much, or I'm widowed now, so I assume I lost it, or my son is on the deed, so I guess I'm out, or I moved once, so it probably doesn't apply, or I was denied years ago, so it's over. False more often than people realize. This is the anti-disqualification moment in this video, because too many older homeowners walk away before the facts are even checked. New York is a good example of why assumptions get stale. The state announced changes beginning in 2026 for enhanced star exemption recipients. Only one resident owner, regardless of relationship, must be at least 65 by December 31st of the benefit year, and income eligibility will be based on resident owners and spouses who reside at the property. If you learned the rules years ago and stopped paying attention, you may be operating on old information. That can cost you, not because the benefit disappeared, but because the rules changed and nobody translated the change into plain language at the kitchen table. Texas also undercuts the self-disqualification reflex. The Comptroller notes that a surviving spouse age 55 or older may be eligible for a deceased spouse's age 65 or older exemption under certain conditions if the home remains the primary residence. That matters to a woman like Gloria, who loses her husband, sees the mail pile up, hears a stranger mention senior tax review on the phone, and assumes she is now in some gray zone where nothing applies anymore. Sometimes the gray zone is real. But very often, the first step is not surrender. It is verification. Illinois shows another version of the problem. The state tax relief guidance says the low-income senior citizens assessment frees homestead exemption income limit for taxable year 2026, payable in 2027, is $75,000 or less. Yet local application pages can present slightly different timing language and filing year references. That is exactly why I tell people not to disqualify themselves from memory. Not from what a neighbor said, not from what a caller said, not from what you think the number used to be. Use the current official rule where you live in the current filing cycle. Then there are title issues, heir property, transfers after death, adult children added to deeds. People hear those words and assume every benefit is gone. Sometimes extra documentation is required. That is true. But more documentation is not the same as no relief. In Texas, heir property owners may still claim homestead-related protections if they provide the required affidavits and supporting documents. The mistake is thinking complexity equals hopelessness. That belief is expensive. And scammers love self-doubt, because self-doubt makes you grateful for bad guidance. When you feel unsure, the confident voice on the phone sounds like authority. When you feel behind, the person offering to take care of it for you today sounds like relief. But the next layer is where that false relief turns into direct financial damage. That is layer 4. And layer 4 is where thousands of dollars can vanish faster than most people think. Myth layer 4 says this: even if the caller is not exactly official, paying a fee to get help is harmless. False. Sometimes those fees are the smallest part of the damage. Yes, maybe somebody charges you $199, $395, or $795 to process something you could have filed directly through the proper office. But the bigger loss often comes from what you handed over to pay that fee. Your birth date, your deed information, your driver's license number, your social security number, your bank details, your signature, your trust. The FTC warns people not to give financial or personal information to callers claiming to be with the government and to hang up and contact the agency directly using a verified number. That advice is not just about avoiding one fraudulent charge. It is about preventing a chain reaction. Once your information is in the wrong hands, the problem can spread. New accounts, fake filings, identity theft, pressure calls, follow-up letters, spoofed numbers. The first loss is money. The second loss is peace. Now let me be careful here. There is a difference between hiring a real licensed professional you chose on your own after verifying them and being pushed by an unsolicited caller into paying for something you do not understand. Those are not the same thing. If you deliberately retain a lawyer, accountant, or enrolled preparer for a legitimate task, that is one decision. If a stranger calls and pressures you to lock in your senior tax savings today for a fee, that is another decision entirely. The first is informed help. The second is exposure. Picture Raymond in Arizona or Anita in Pennsylvania. They get a call late in the afternoon. The caller already knows the address, says there is a senior tax correction, and tells them this will prevent overpayment next cycle. They pay a small fee because it sounds easier than reading county instructions. Months later, nothing changes on the bill. Worse, they start getting more calls. Then maybe a credit issue appears. Maybe a fake tax notice shows up. That first phone call did not just cost a fee, it opened the door. Here is the protection rule. Never complete a benefit claim because a stranger contacted you. Start over from zero. Hang up, pull your latest tax bill, go to the official county assessor, appraisal district, treasurer, or state tax department website yourself. Use the phone number listed there, not the one the caller gave you. Ask whether the program exists, whether you are already enrolled, what the official form is called, whether the filing is free, and whether your locality ever initiates this process by outbound call. That one habit will save a lot of people a lot of money. Myth layer 5 is the quiet one. It sounds practical. It sounds low drama. It sounds like this: if I miss it this year, it's probably not a huge deal. False. Missing 1 year can become missing several. Missing several can mean thousands of dollars that never come back, or only partly come back, depending on local correction rules. This is where the title of this video becomes painfully real. The call costs you money, not only if you pay the caller, but if it keeps you from acting correctly while the calendar keeps moving. Cook County says the basic homeowner exemption saves a property owner an average of about $950 each year. That is before we even get into senior-specific programs. So imagine a homeowner who misses that kind of relief for 3 years because they assumed it was already in place, or because a bad call convinced them someone else was handling it. Now you are near $2,850 in average missed savings on just one exemption framework. Add a senior exemption or a senior freeze issue, and the number can grow fast. Texas can be even more dramatic because the exemption amounts tied to school district taxable value are large. A general residence homestead exemption of $140,000 plus an additional $60,000 for age 65 or older or disabled homeowners changes the taxable base substantially. The actual dollar savings depend on local rates, which is why I am careful not to promise one universal tax bill number. But common sense tells you that failing to claim relief against $200,000 of taxable value is not a trivial mistake. It is the kind of mistake that can follow you year after year. In California, failing to file the BOE-266 means the $7,000 reduction in taxable value is not doing anything for you. In Colorado, failing to apply means you are not receiving the exemption that removes 50% of the first $200,000 of actual value for qualifying senior homeowners. In Illinois, senior exemptions and freezes can change assessed value in meaningful ways, and some programs demand annual action. One missed cycle becomes two because life gets busy, because you got sick, because your spouse died, because the paperwork looked annoying, because nobody explained the difference between being entitled and being enrolled. That is why I get frustrated. Frustrated when people say, well, it's just taxes. I'll deal with it later. Later is expensive. Later is where the money disappears. Later is where the widow on a fixed income pays more every year than the couple next door simply because one household filed and the other assumed. Same age, same block, same kind of house, different paper trail, different result. That is not a character flaw. It is a systems problem, but it still hits your bank account all the same. So what does the truth mean for your money this year in 2026? It means you should stop treating homeowner tax relief as a rumor and start treating it like a claim file. A claim file has names, dates, offices, forms, and proof. If you own and occupy your home, are 65 or older, are disabled, are a surviving spouse, have low to moderate fixed income, or recently inherited or retitled a homestead, you may be in the zone where 1 hour of verification can be worth hundreds or thousands of dollars over time. Not theoretically, actually. In Texas, in 2026, the school district homestead exemption amount is $140,000, with an additional $60,000 for age 65 or older or disabled homeowners. In California, the homeowner's exemption remains a $7,000 reduction in taxable value if properly claimed through the county assessor. In Colorado, qualifying senior homeowners can exempt 50% of the first $200,000 of actual value if the long ownership and occupancy rules are met. In Cook County, the office says the homeowner exemption averages about $950 a year in savings. These are not vague benefits. These are real numbers attached to real filing systems. This year also means rule changes matter. New York's enhanced STAR changes beginning in 2026 are a perfect example. If you are relying on an old conversation from a neighbor, a church friend, or a cousin who filed years ago, that information may already be stale. The same is true if your county has shifted to online filing, changed deadlines, or altered renewal instructions. The price of outdated information is not just confusion. The price is a higher bill, a missed deadline, or a lost opportunity to correct the record before the window closes. It also means you should become suspicious of convenience when convenience arrives uninvited. If a stranger wants to make a complex tax relief process feel fast, easy, and urgent, you should assume they are selling confidence, not accuracy. Accuracy is slower. Accuracy means reading the county page. Accuracy means confirming whether your exemption auto-renews or must be refiled. Accuracy means verifying whether a freeze program is income tested annually. Accuracy means understanding whether a state relief program is an exemption, a credit, or a deferral with a lien. And I want to say this with respect. None of this means you are behind, careless, or not good with money. The paperwork around senior homeowner relief in America is fragmented. That is the reality. Smart people miss things all the time because the rules are local, technical, and poorly explained. The point of this video is not to shame you. It is to restore leverage. Because once you understand the real process, the phone call loses its power. The myth loses its power. And your next step becomes clear. Here is what I want you to do first. Pull your most recent property tax bill and write down 3 things: the exact owner name on the property, the county or appraisal district handling the bill, and whether any exemption lines are already listed. Do not guess. Read the paper. If you cannot find it, log into your county portal or call the official office using the number on the bill or official website. Your first job is not filing. Your first job is establishing your current status with certainty. Second, identify the correct office. In Texas, you are generally dealing with the County Appraisal District for homestead exemptions. In California, you file the Homeowners exemption with the county assessor using BOE-266. In Cook County, exemption applications run through the Cook County Assessor's Office. In New York, STAR questions may involve the assessor's office or the state homeowner benefits system, depending on whether you receive a credit or exemption. In Oregon's deferral program, the filing starts with the county assessor. The office matters because the wrong office creates delay, and delay creates loss. Third, ask a very specific question. What is the exact form, name, deadline, and renewal rule for the homeowner or senior property tax relief I may qualify for? If you are in Texas, ask about Form 50-114 and the before May 1 filing deadline. If you are in California, ask for BOE-266 and whether you are still in time for the full exemption year. If you are in Cook County, ask whether your senior exemption is already applied and whether your senior freeze requires a new filing before the 2026 due date. If you are in New York, ask whether you are receiving a STAR credit or STAR exemption, because those pathways behave differently. Fourth, do not self-disqualify while asking. Do not call the office and say, "I probably don't qualify." Say this instead: "I am a homeowner. I occupy the property. I am over 65. Or, I am a surviving spouse. Or, my income changed. Or, my child is on the deed. Or, I inherited the home." Then ask, "What programs should I verify?" That is a completely different conversation. One shuts the door before the facts arrive. The other opens the file and lets the office tell you what is real. Fifth, make one household rule today. No tax relief claim will ever be completed during an incoming phone call. Ever. Not yours, not your spouse's, not your mother's, not your aunt's. If someone calls, the answer is simple: "Thank you. I will contact the office directly." Then hang up. No confirming numbers, no reading back codes, no just verifying date of birth, no card payment, no emotional conversation. That one sentence can stop a lot of damage before it starts. Sixth, if you discover something should have been on your bill and is not, ask what correction path exists. Some jurisdictions allow retroactive correction or a certificate process for missed exemptions. Cook County, for example, explicitly references certificates of error for certain late or missing exemption situations. The details vary, so do not assume your county works the same way. But ask the question. The worst answer you can get is no. The much better answer is that there may still be a route to reclaim part of what was missed. Seventh, if the program is income-based, verify which year's income is being used and whether the threshold changed. This matters in places like Illinois, where senior freeze eligibility depends on household income rules that can shift by tax year, and where state guidance and local pages must be read in context. It matters in New York, where STAR eligibility rules are changing. It matters everywhere people rely on last year's memory instead of this year's instruction. Current year, current office, current threshold. That is the discipline. Eighth, if you help a parent or older relative, do not just ask whether they already get a discount. Ask to see the bill. Ask whether a senior exemption, homeowner exemption, freeze, credit, or deferral is actually listed. Ask whether anything requires renewal. Ask whether the house title changed after a death. Ask whether suspicious calls or letters have arrived. A lot of adult children think they are checking in on finances when really they are only checking in on feelings. You need paper, not impressions. And ninth, remember the order of operations. Verify the office. Verify the form. Verify the deadline. Verify whether filing is one-time or annual. Verify whether your benefit is an exemption, a credit, or a deferral. Verify whether a surviving spouse, heir property, disability, or age-based rule applies. Then file through the official channel, not through fear, not through pressure, not through a stranger's shortcut, through the actual system, on purpose. That is how you turn a myth into money. To make this easier, I put together a free homeowner protection checklist you can use before you file anything or return any call. It walks you through the exact questions to ask, the documents to gather, the differences between an exemption, a freeze, a credit, and a deferral, and the red flags that tell you a helpful phone call is really a threat. It also gives you a one-page family script you can keep by the phone, so if a suspicious caller reaches you or an older relative, nobody has to improvise under pressure. And let me say this the same way I say it every time. I am not charging you for that checklist, and I do not get paid because you verify your benefit. I make these because too many people who did everything right for 40 years are still losing money on technicalities, silence, and bad information. If that resource helps you catch even one missed exemption, one fake call, or one renewal rule you were about to overlook, then it did its job. If this corrected the record for you, send it to the one person in your life who still believes an official-sounding phone call must be safe. Send it to the widow on your street. Send it to the brother who always says, they'll take care of it automatically. Send it to the friend who thinks being eligible is the same thing as being enrolled. It is not. And that false belief is costing older Americans real money every single year. Share this as an act of defiance against confusion, pressure, and silence. If you want more plain English guidance on protecting your home, your money, and your family from expensive paperwork mistakes, subscribe and tap the bell. Here on this channel, we do not just talk about what you deserve. We talk about how to actually claim it, protect it, and keep it from slipping away through a loophole, a missed filing, or one very expensive phone call. I'm Emma Smith. Thank you for being here, and I will see you in the next one.